Hi everyone, welcome to another episode of Game of Investing Podcast, episode number 6. Today I'm going to delve into one of the most widely misunderstood concept about power of compounding. Well, this is a tribute to the legendary investor Charlie Munger, who recently passed away. And the most important lesson I got away from Charlie Munger is the statement he made. The first rule of compounding is do not interrupt the compounding process unnecessarily. And this is a very deep statement that he made, because what do I mean by most people do not get the concept of compounding in terms of investing? Because whenever we talk about compounding, people immediately get into the formulae and then they start calculating, how many doubles, etc., etc. Well, all that is right, but fundamentally there is something about the way we invest in companies that is related to compounding. Let me explain to you with an example, and I'll clear what that gap of understanding most people have is about. Now let's take an example of a stock like Nvidia, right? Suppose you had invested in Nvidia 5 years back. You're one of the smartest person in the room. Great investor, well done. You invested in Nvidia, it went up, the stock went up, you can see it on the screen, went up 12 times in the last 5 years. Great job. Now, what would normal person do? Most investors don't get the concept of compounding because of this factor. Listen carefully. Now, if you had sold, most people will try to sell it out because you think, got my profits, 10x, 12x, what else do I need? Now, think about this point. Suppose the stock goes up, Nvidia stock goes up, doubles up from here, which means the stock price doubles in the next 4 years, let's assume, or 5 years, right? Stock price doubles in the next 5 years. But what is your return going to happen? Your return is going to convert from 12x to 25x. The stock just doubles from here in the next 4-5 years, but your return is going to be 25x, not 12x. That's a huge jump. This is why compounding is magical and back-ended. Now imagine Nvidia stock goes up 4 times the next 10 years. I'm not projecting too much, but just 4 times the next 10 years. You already have a winner in hand, which has gone up 12x. And 4 times from here, your stock has gone up 50x approximately, 50x. Now imagine all you're doing is sitting on already a winner stock, is sitting on a winner and waiting out another 10 years to find that 50x. Now instead, suppose you sold the stock today or yesterday, right? You got a 12x. What is going to happen? You have to pay a tax of 15 to 20%, which means you're going to shave off from 12x, your return is going to come down 15-20%. That is, you're going to get a return of only 10x, not 12x. So there's already a loss. Now the second thing going to happen, you need to find another winner, another great idea that has to go up 10x, and from there another 5x. So you have to find another winner that can go up 50x. Instead, a better idea is to just sit through Nvidia for the next 10 years and get that 50x. You already have done the work, found the great company that is so innovative and has so much optionality, because Nvidia is already a winner. It's a winner because they have the largest market share in cloud computing, in GPUs, and one led to another. What they started as GPU for gaming led to high performance computing that got significant leap in cloud computing business, which was a rage in 2015-16 onwards. That led to another, which is supercomputers and artificial intelligence, because a high performance computer, they are the leaders. They already are the leaders, and probably they might become a complete monopoly. They could rule the AI game for the next 5 to 10 years. So you're already sitting on a winner. You don't need to do much to get that 50x. Instead, if you cut, you have to pay tax and then find another winner. Opportunities are very rare in life, and when you're already getting a winner which has done extremely well with a great management leader like Jensen Huang, the better idea is to sit. And again, Nvidia is just an example that you take a Tesla, you take any companies out there which are already winners. Most people try to chase the next winner, which is very rare. So when Charlie Munger said this concept of compounding, do not interrupt it, and this is one reason Berkshire Hathaway do not sell their shares. They are sitting on their winners, not paying taxes, deferring taxes, and they're compounding it, because once you get a 10, the next double is taking you to 20 times, and the next double is taking you 40 times. That's the beauty of compounding. It's a doubling, and it is not only the formula like how fast you can become rich. Apply compounding in the way you invest and the way you think before selling a great winner. Just wanted to bring this up in today's podcast. Signing off, Sandeep Anand.